So how big is this tsunami of bankruptcies and defaults likely to be? And we know some of the probable suspects in retail and energy, but where might it hit in places that we don't expect right now?
Tyler, I think, we haven't seen the worst yet for sure as far as the numbers of filings. And, it feels like we've been going through this for a long time, but it's only been a few weeks. And so it takes a while for liquidity to dry up and for the full brunt of this to hit companies, for them to plan with their advisors, the filing, to have some preliminary negotiations with their creditors, perhaps in the right situations. But, obviously, we're going to have a massive number of filings in retail. I think we'll have many, many in retail. And, those are in the works, and we will see them in the coming days and weeks. There hasn't been a particular press to file those because, frankly, the stores aren't open and, you can't even liquidate the inventory properly right now. So those are coming, though. And then, obviously, there are going to be a great number of bankruptcies still to come in the energy sector. And we'll see those, I think, in the coming weeks and months. And then behind that, you have industrials, you have some tech and telecom that's going to get in trouble. And I think what's happening right now is everyone is evaluating the longer term implications of this. I mean, obviously, in the near term, we've never had an unprecedented event to cause revenues to shut down like this. And certain sectors are exempt. Technology, for example, is doing very well, as evidenced by the rally in the technology-led equity markets. But, we've seen these cycles many times. And the first thing that gets cut is unnecessary expenditure and things like marketing. But then after a while, boards sit down and say, well, what about R&D? Do we really need to have that R&D budget next year if our revenues are going to be down by 20, 30% or whatever the case might be? So we may see it go that well.
Is next year likely to be worse than this year because either the way maturities are stacking up or because that's when it's likely ultimately to hit, that they'll limp through 2020, but in 2021, all of the reserves are gone?
I think you may very well be right with that for the reasons you cited as well as other reasons. I think the jury's out, and obviously bankruptcy should be a last resort, right? So in cases we're involved with, we try every which way to avoid bankruptcy. Bankruptcy is protracted. It is incredibly expensive, and I can give you many examples of companies that might have actually had equity value if not for the expenses of bankruptcy. So I think companies should try in every way they can to avoid bankruptcy, and I think that's a lot of what's going on right now. And creditors have actually been fairly reasonable in prolonging the process and giving companies extensions to try and see for themselves where things are going. But just on the pure numbers, we track a universe of companies that are in what we call distress, and we define that by companies that are trading, whose bonds are trading in excess of 10% yield. And everybody knows that in the current environment, that signifies distress. And that universe right now has over $300 billion of face amount of bonds in it. And of that, only $3.5 billion or so mature this year, but a full 25 mature next year. And so we're going to have a lot more maturity issues next year if companies aren't successful in extending those. And of course, you'll have the liquidity issues that go with it, usually force the bankruptcies.